So first question, what will happen to property values as interest rates slowly rise? The Bank of England raised interest rates for the first time in a decade in November. Gilt yields are starting to slowly move out. What will this mean for property values? Well, if we overlay the average all property yield from a chart Richard showed earlier, with the 10-year government bond yield in the blue, and look at the spread between the two in the grey shading, you can see there's a big cushion. The grey shading shows that there's plenty of basis points between the two, so plenty of cushion for property yields to withstand increases in the gilt yield over the next 12 to 18 months. This is Oxford Economics projection. So in this context, property values are unlikely to be too affected in the near term. Of course, this varies by segment of the market. Some of the lower yielding parts of the market could come under slight pressure. Perhaps we won't see any further compression, particularly as investors start to expect future increases in interest rates moving forwards. But a fairly encouraging picture for property should continue to look relatively attractive in 2018. The next question, given the prime versus secondary spread, will investors increasingly look to secondary property and asset management options during the year? We do have a national office and industrial report in conjunction with all the market and sub-market reports we have. And when considering this question, we might want to look to the sort of national picture, look at what fundamentals are doing across the entire country. And the picture is pretty positive for investors who wanted to move up the risk curve in different towns and cities. This shows the supply, demand and vacancy story, both the last 5 years and the forecast. And pretty strong demand over the last few years, particularly in 2014, but also in 2017, has pushed the vacancy rate down to very low levels. And moving forwards, the picture across the country is for further vacancy compression as 2018 unfolds, before maybe a slight rise thereafter. I should say that a lot of these blue bars in the net deliveries are in London, so different dynamics perhaps between London and the rest of the UK, but in aggregate a pretty good picture and could encourage more investors to look at secondary property. Well, growth in rents, but both at a 3-star and a 4 and 5-star sort of secondary and prime proxies, and across the UK, has been falling away since reaching a peak in 2015. Actually turned negative towards the end of 2017, albeit influenced partly by London because of the amount of office stock in London, and this is a space-weighted series. It's kind of skewed a little bit by that, with many regions continuing to record pretty robust growth and will continue to do so. And interestingly, as the chart shows, that orange line is projected to outperform the blue line. So secondary property, according to our models, could perform quite well in that context. On the industrial side, at national level, very similar story. Sharp vacancy compression over the last few years. Vacancy rates across the industrial market at very low levels. And whilst supply is likely to come in and push the vacancy rate upwards slightly, investors could, in this environment, be encouraged to take on perhaps slightly more riskier investments. Not that I'm suggesting you do so. We're not giving advice here. We're just putting a bit of context around what might happen, based on our data and our forecast models. And on the rent side, continued growth is expected in all parts of the industrial market, both light industrial and green, but also logistics and the industrial market as a whole. And it's likely to outperform offices at a national level according to our forecast models. So back to the question, not a bad environment to perhaps take on slightly more riskier options if that is a strategy want it to be followed. Third question, which markets and sub-markets are best placed to outperform? Obviously, I've just given the national picture, but that doesn't really help in terms of stock or market selection. So I'm now going to look at sort of the best performing markets, the best performing sub-markets, using a brand new analytics functionality which was released onto the CoStar system a few weeks ago, giving clients the ability to rank markets and sub-markets against each other by building quality, but across various different metrics like net absorption, rent growth, investment volumes, etc. So I'm just going to show a few examples of that, a few results from that new analytics functionality. Firstly, office market rankings by rent growth, which are the strongest and the weakest. It may surprise some people to know that Hertfordshire has recorded the strongest rent growth over the last 12 months, followed by the likes of Suffolk, but also including Luton, Cambridge, places like Brighton, but also big cities like York, Birmingham and Bristol recording 6% plus and above rent growth. Now I know what you're thinking. Why wasn't I armed with this kind of information last night? It would have been perfect conversation fodder for your Valentine's Day dinners. I was armed with that, and so my wife has this kind of information. I had a great time. For next year. So the flip side of that, which markets are rents coming off, because it is a divergent picture across the UK. And you can see that Tees Valley and Durham has recorded the weakest rent growth, 7% declines. But you can see the likes of City and Midtown in there, some sub-markets in the city, particularly in the city core, rents are coming off, but also in Midtown and places like Hull. So quite interesting dynamics happening in the office sector. In the industrial side, I'm now focusing on net absorption, which markets have attracted the strongest and weakest demand. So ranking the markets by positive net absorption, the likes of Essex, Bristol, Manchester, Shropshire, Leicester have all recorded very strong net absorption, helped by the opening of Amazon sheds or big distribution sheds by supermarket retailers. And conversely, the markets which have recorded the negative absorption have seen places like Hull, Hertfordshire, Lincoln and Surrey have seen closures of big distribution sheds by the likes of Tesco and Co-op. So again, quite interesting things to pull out of this new functionality, and I encourage you all to do that. Another thing you can do, and maybe more for value-add opportunistic investors, is rank office sub-markets by high to low vacancy. So these are the office sub-markets with the highest vacancy across the country, looking at the poorer quality segment, the 1 to 3 star. And these could be deemed markets to steer clear of if you're a core investor. Conversely, perhaps there's refurbishment potential here if the 4 and 5 star parts of the market are performing well in these places, or a big trend over the last 5 years, perhaps an office building could be acquired cheaply for conversion to residential or hotels, for example. So what is the outlook for London offices? The fourth question, which sub-markets are likely to outperform? Now, before I dive into this, I would say I'm a proud Londoner, and the only way I could really prove that is to Photoshop my face onto Dick Van Dyke in Mary Poppins. But the point is that, I've got no interest in talking down London, so any mildly negative comments I have about any parts of London are data-led and delivered with a heavy heart. But to start with the positive, because it is a positive, Central London has performed pretty well in 2017. If we look at supply, demand and vacancy over the last 10 years or so, I've highlighted 2017 here. Although deliveries did outweigh net absorption, big increase in deliveries, pushing the vacancy rate up slightly. Net absorption was pretty strong, certainly compared to 2016, and a lot better performance perhaps than people expected at the start of the year. A lot of this was driven by tech demand and by some moves agreed a couple of years prior. You saw the likes of Amazon moving into Principal Place, Google taking more and more space in King's Cross, Facebook occupying Rathbone Square, and the likes of Snapchat and Spotify expanding their presence in Midtown. So a very strong tech story, and decent performance for central London as a whole. That said, at a sub-market level, some sub-markets have attracted more demand than others. If we look at the sub-markets that have attracted the most amount of absorption, these have been the sub-markets where these tech occupiers, these creative occupiers have tended to congregate to. So the city fringe has done pretty well to attract demand. City core west has done quite well following the Bloomberg move. Walbrook is just inside our city core west boundary. But King's Cross, NoHo, Covent Garden, these kind of sub-markets have done well to attract demand. It's where creative industries largely want to be, and so they've outperformed. Conversely, we've seen negative demand in sub-markets like the City Core North, Docklands, and City Core East, sub-markets that have done slightly less well over the last 12 months. And going back to the previous slide again, no discussion of 2017 demand can be complete without the elephant in the room. WeWork, you could barely a week passed in the second half of the year without WeWork taking one big space or other across London. And it was really, a remarkable expansion. Remarkable to the extent that WeWork are now the biggest private sector occupier, I say occupier, but the biggest private sector occupier in central London. This takes into account pre-let space such as the big pre-let at South Bank Place just down the river, but quite remarkable from a standing start of from zero about 4 years ago. WeWork now occupy or have in their control 2.4 million square foot of offices. So a big trend, and it doesn't look like slowing in the near term. But there have been impacts. We've seen impacts across different parts of the market, particularly on smaller buildings. So a piece of analysis we did a couple of months ago looked at vacancy rates in buildings of 25,000 square foot or less. And this is the pattern. This is a chart direct from the product. Very interesting that WeWork took their first major London office at 199 Bishopsgate at the end of 2014. And from that point onwards, vacancy rate in these smaller buildings have moved up. Some of these startups and SMEs that previously might have congregated towards these buildings, perhaps now taking WeWork space instead, and we've started to see some impact on that part of the market, which is interesting for investors to monitor going forwards. But panning out again to the central London level, a big theme at the moment is there's still lots of construction underway in London. This looks at the amount of built space under construction at the end of each quarter over the last 15 years or so. And while it's come down from a peak in mid-2016, there's still over 10 million square foot under construction across central London, much higher than the average. You can just look out the window to see all the cranes in the air. So as a leading indicator of what's going to happen going forwards, it's interesting to look at our construction data for that. Again, some sub-markets are going to see a lot more deliveries than others over the next few years. led by the City Core North and the City Core East, EC2 and EC3. Helped by some of the big schemes like 22 Bishopsgate, 100 Bishopsgate, 100 Liverpool Street, some of the bigger schemes under construction across the river. Now, there has been quite a lot of pre-letting activity. You know, around half the space is pre-let. 100 Bishopsgate has attracted a few good pre-lets, which is great for those buildings. However, the impact on the vacancy rate is perhaps going to be more muted, more neutral, because there's lots of pre-lets, but also lots of moving around. So Goldman Sachs will be vacating a few buildings on Fleet Street when they move. Freshfields will be moving from Holborn, RBC and Jeffreys when they move to 100 Bishopsgate. Ashurst will be moving from Appold Street to the Fruit and Wall, and M&G and WR Barclay will be moving sideways too. SMBC, Richard mentioned a deal that closed a couple of days ago. They'll be moving from Mansion House to 100 Liverpool Street when they move. So this is just to make the point that while it's great for these buildings to get these pre-lets, the impact on the vacancy rate might be more neutral. And if we pick one sub-market in particular, EC2, city core sub-markets could see further vacancy increases based on the data, based on the construction data we have to our knowledge and knowledge of known move-ins. The vacancy rate in the city core is in the green line there, and it could move upwards over the next few years as a result, despite registering positive demand. So, a noteworthy thing, and we do have forecasts and this chart for every sub-market that we track. But some sub-markets appear more stable and resilient, places like in Midtown and the West End, far less supply pressures underway and are likely to see pretty healthy demand going forwards. This is Covent Garden, and you can see that there's going to be one big delivery in Covent Garden, but the forecast suggests that vacancy rates will continue to move downwards. So the picture is always more nuanced when you drill down to a sub-market level. And while rents are falling in London as a whole, you can see that outer London rents are still growing, quite strongly. This again looks at the London market ranking by rent growth, and places like Harrow, where I was actually born, is just a coincidence, and Kingston upon Thames, Brent, registering 3% and above rent growth as other parts of London are in decline. So picture, as ever, is nuanced. And final question, will the shift in spending from London to the regions continue in this context? Well, looking at the vacancy rate and rent picture across the big six office markets, vacancy rates have continued to compress to a sort of 10-year low. Rents continuing to increase. In this context, perhaps more investors will look to the regions. But, London still has plenty of strengths and is likely to continue to see a lot of foreign demand. So just to summarise, UK investment surprisingly strong in 2017. Industrial alternatives popular, as Richard's shown, retail less so. Investors increasingly keen on the regions, and yields came down in the second half of the year. 2018 outlook appears relatively positive. Property yields offer a big spread over gilts. Robust fundamentals, particularly in the regions, could encourage a move up the risk curve. Market and sub-market and asset selection will be key, and the charts have shown that that's increasingly possible to look at that kind of things in CoStar. The structurally sound sector should remain popular. There's been a lot of talk about last mile logistics. Sectors like that are likely to see more and more attention. And of course, the one big uncertainty amidst all of this is Brexit. But there's enough talked about Brexit. I don't need to talk about that. So that's it from me. Thanks very much for listening.